Hello traders, Gary Wagner here. January 15th, it is Friday. Happy Aloha Friday, as we say on the islands. On today's weekend review, we're going to take a different perspective. Typically, we spend most of our time talking about technical indicators and we look at a lot of charts. But my sense over the last couple of weeks has been that there is a big disparity between the fundamentals at play and the market's reaction to it, market sentiment. And it is for that reason that we're going to change it up just a little bit. I hope you enjoy the show. Not only did we see gold lose ground today, but also this week and over the last 2 weeks collectively, we have seen gold prices drop from approximately $1,960 to current pricing at $1,827.70. Considering the events that have occurred over the last 2 weeks, I find the logic of market participants lacks the kind of clarity needed to be able to look at the long-term implications of what has been happening. Considering last week's insurrection that resulted in 5 deaths as militants broke into both the Senate and Congress, a vote to impeach President Trump, which was effectively passed by the Congress, and most importantly, data from the Treasury Department indicating that the economy continues to contract, as indicated by a report released this week by the U.S. Treasury Department that indicated that the budget deficit rose 60.7% in the first 3 months of this fiscal budget year, which began in October and is now at a record $572.9 billion. The fact of the matter is the national debt continues to mount. Massive employment continues to be a big component of life in the United States, and the pandemic continues to ravage the United States as well as other parts of the world. But actually, the data that is most alarming is that considering that the United States government borrowing has surged from 61% of the GDP at the end of 2007, and by the second quarter of last year had jumped to 127% of GDP, we can see how quickly that debt is mounting. And oddly enough, it didn't begin with the pandemic, it ballooned with the pandemic. Because prior to the pandemic, the combination of Trump's 2017 tax cut and the lack of any serious spending restraint helped both the deficit and debt soar. So when the once-in-a-lifetime viral disaster came in and slammed this country and contracted our economy, then we added $3 trillion on top of that debt fire that had already occurred. According to ProPublica, our national debt has reached an immense level relative to our economy, nearly as high as it was at the end of World War II. But unlike 75 years ago, the massive financial overhang from Medicare and Social Security will make it dramatically more difficult to dig ourselves out of the ditch. But what I found to be one of the most obscure and really alarming facts is that at this point, the additional debt by the United States government has now equaled the debt level of Italy, considering that for the past decade, economists have agreed that Italy was the weak link in terms of the Eurozone itself. For us to be compared with them is startling. It has been said that a picture is worth 1,000 words, and the picture we are looking at is GDP compared to expenditures. And what you can see is during World War II, we were just above 100%. They've marked 2020 as 98%, and as I said, the numbers that just came out by the Treasury Department says that by the second quarter of last year, we are spending 127% of our GDP, which is exactly why I felt compelled to have a different take on this weekend review. because I can show you charts, talk about the technicals, but it is the underlying fundamentals that do not match up with what we are seeing in the market. So over this long 3-day weekend, because markets are closed on Monday in observance of Martin Luther King Day, we will remain long our positions in gold, silver, GLD, and SLV. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Tuesday for the next daily update and review. Bye-bye.